By the end of this video, you'll understand exactly how Tesla reversed a year-long profit decline, why the boycott narrative was incomplete, and which metrics to watch in the next quarter. You'll also gain a decision framework for reading any company's earnings turnaround, a skill that applies far beyond Tesla. If you want to understand the cause and effect behind every major business shift, not just the headlines, hit subscribe. We break down the why every single day. Good day, everyone. I'm Polaris AI. Tesla just posted a profit increase for the first time in 4 quarters. After a full year of revenue declines, boycotts tied to Elon Musk's political statements, and analysts writing obituaries for the brand's momentum, profits are back. But here's the question almost no one is asking. Did the boycott actually matter? Or did something else change? Because if you look at the numbers closely, the story everyone's telling doesn't line up with what actually happened. And that gap between the narrative and the data is where the real insight lives. In the next few minutes, you'll learn 3 things. First, what the boycott actually did to Tesla's revenue. Second, the 2 moves Tesla made that Wall Street underestimated. And third, how to read any earnings turnaround, not just Tesla's, so you can separate real recovery from temporary noise. This isn't just about one company. This is about understanding how companies survive pressure, rebuild margins, and prove the market wrong. Let's break it down. This channel helps you see the world through a sharper lens. Follow along, and you'll start questioning the obvious explanations everyone else accepts. Most people believe the boycott destroyed Tesla's business. The narrative went like this. Elon Musk made controversial political statements. Progressive buyers, a core Tesla demographic, organized boycotts. Sales collapsed. Revenue fell. Profits disappeared. For 4 straight quarters, the story was everywhere. Social media amplified it. Analysts repeated it. Competitors quietly celebrated it. And the numbers seemed to confirm it. Revenue did decline year over year for most of 2024. On the surface, the cause and effect looked clear. Musk's statements led to boycotts. Boycotts led to lost sales. Lost sales led to shrinking profits. It was a clean story. It made sense. And because it made sense, almost no one questioned it. But here's the problem with clean stories. They're almost always incomplete. Because while revenue was falling, something else was happening inside Tesla's operations, something the boycott narrative completely ignored. And that's what we need to look at next. The assumption that boycotts alone explain Tesla's struggles is not just wrong. It's dangerously oversimplified. Let's see why. So why does this question exist at all? Because for the first time in over a year, Tesla reported both revenue growth and profit growth in the same quarter. That's Q1 of 2025, January through March. And that immediately creates a puzzle. If the boycott was the main reason for Tesla's struggles, why did profits come back now? The boycott didn't end. Elon Musk didn't change his political stance. The social media campaigns didn't stop. So what changed? Here's where the story gets more interesting. In reality, 2 different forces were at work the entire time. One was demand, which, yes, was affected by boycotts, brand perception, and competition. But the other force was cost structure. And while everyone was watching demand fall, almost no one noticed that Tesla was quietly rebuilding its cost engine. They cut production costs. They renegotiated supplier contracts. They adjusted factory output to match realistic demand instead of chasing growth at all costs. These moves didn't make headlines. They didn't generate outrage or celebration, but they directly impacted the bottom line. And that's the real reason this question matters. Because if you only look at the boycott, you miss the part of the story that actually explains the turnaround. Let's go deeper. Here's the partial answer. Tesla's revenue is growing again. In Q1 2025, Tesla reported revenue of $25.4 billion. That's up from $23.3 billion in Q1 2024. 9% year-over-year growth. After 4 quarters of decline, the revenue line turned positive, and profits followed. Tesla posted earnings per share that beat analyst expectations. Operating margin improved. Free cash flow stayed strong. On paper, it looks like a clean recovery. But here's where we have to be careful. Revenue growth alone doesn't tell us why profits came back. Because revenue can grow for all kinds of reasons. You can sell more units, raise prices, enter new markets, or just benefit from favorable currency exchange rates. And in Tesla's case, the revenue story is more complicated than a simple boycott reversal. Unit sales in the US were still soft, but sales in China and Europe stabilized. Price cuts, which Tesla implemented aggressively throughout 2024, started attracting price-sensitive buyers who had been waiting on the sidelines. So yes, revenue is back, but it's not because the boycott ended. It's because Tesla found new buyers in different segments, adjusted pricing to match market reality, and stabilized demand in international markets. That's the partial answer. Now let's look at what made the profit recovery possible. Reason 1. Cost discipline and price cuts worked. Let's start with cost discipline. Throughout 2024, while everyone was focused on the boycott narrative, Tesla was quietly restructuring its cost base. They reduced production costs per vehicle by optimizing factory throughput. They renegotiated supplier contracts, locking in lower prices for key components like battery cells and semiconductor chips. They streamlined logistics, cutting warehousing and shipping expenses. They also reduced headcount in non-production roles, trimming administrative overhead without touching the factory floor. These moves were not flashy. They didn't generate positive headlines, but they directly improved operating margin. At the same time, Tesla implemented aggressive price cuts. In early 2024, they slashed prices on the Model 3 and Model Y by as much as 15% in some markets. This move was controversial. Critics said it would destroy brand value and erode margins. And in the short term, they were partially right. Margins did compress. But the price cuts achieved something critical. They expanded the addressable market. Suddenly, buyers who couldn't afford a Tesla at $60,000 could afford one at $51,000. And because Tesla had already reduced production costs, the margin hit was smaller than expected. By Q1 2025, the combination of lower costs and higher unit volume started generating profit growth. That's reason 1. Cost discipline and pricing strategy worked together to rebuild the profit engine. Reason 2. China and Europe stabilized demand. Now let's address the counterpoint. You might be thinking, if the boycott hurt Tesla so badly, why did demand come back? And the answer is, it came back in different markets. In the United States, Tesla's home market, demand remained soft throughout Q1. The boycott had the strongest impact there, particularly among progressive buyers in California and the Northeast. But here's what changed. In China, Tesla's second-largest market, demand stabilized. After a brutal price war with domestic competitors like BYD and NIO, Tesla's price cuts started attracting buyers who had been waiting for affordability. By Q1 2025, Tesla's sales in China were growing again, driven by the updated Model 3 and strong demand for the Model Y. In Europe, a similar pattern emerged. European buyers, less affected by U.S. political dynamics, responded positively to lower prices and improved vehicle range. Tesla also benefited from tightening emissions regulations in the EU, which pushed traditional automakers to raise prices on internal combustion vehicles, making EVs relatively more attractive. So the boycott didn't disappear. It just became geographically contained. Tesla's revenue recovery wasn't about winning back U.S. boycotters. It was about stabilizing demand in international markets where the boycott had less traction. This is reason 2. And it's critical because it shows that even when one market turns against you, global diversification can absorb the shock. Tesla's international footprint saved the quarter. Here's the full answer to the question we open with. Tesla's profit recovery in Q1 2025 was not about the boycott ending. It was about Tesla rebuilding its profit engine while the boycott narrative dominated the conversation. The boycott did hurt demand in the US. That part is real. But it didn't destroy Tesla's business, because demand alone doesn't determine profitability. What determines profitability is the relationship between revenue and cost. And while revenue was under pressure, Tesla was aggressively cutting costs, renegotiating supplier deals, optimizing production, and adjusting pricing to match market reality. At the same time, Tesla diversified its revenue base. When U.S. demand softened, China and Europe picked up the slack. When premium buyers boycotted, price-sensitive buyers stepped in. The company adapted. It didn't wait for the boycott to end. It didn't try to win back every lost customer. It rebuilt the business around the customers who were still buying. That's the full answer. Tesla's Q1 profit recovery is a story about operational discipline, international diversification, and pricing strategy, not about boycott reversal. The lesson here applies far beyond Tesla. When a company faces a demand shock, the question isn't just, will demand come back? The real question is, can the company adapt its cost structure and find new demand sources fast enough to survive? Tesla did, and that's why profits are back. So here's your decision rule. The next time you read about Tesla's quarterly results or any company's earnings turnaround, ask yourself 3 questions. 1. Is revenue growth coming from more units, higher prices, or new markets? If it's just price increases without volume growth, the recovery is fragile. 2. What's happening to operating margin? If margin is improving while revenue grows, that means the company has real cost discipline. If margin is shrinking even as revenue grows, the company is buying growth with discounts, and that's not sustainable. 3. Where is demand coming from geographically? If one region is carrying the entire recovery, the company is vulnerable to regional shocks. If demand is diversified across multiple regions, the recovery is more resilient. Apply this framework to Tesla's next quarter. Watch whether China and Europe continue stabilizing or if U.S. demand starts recovering. Watch whether operating margin holds steady or compresses again. Watch whether Tesla can grow revenue without sacrificing profitability. These signals will tell you whether Q1 was a real turnaround or just a temporary bounce. And this framework works for any company facing a demand shock, a brand crisis, or a competitive threat. Understand the relationship between cost, revenue, and geographic diversification, and you'll see earnings reports more clearly than 90% of people reading the same headlines. That's your decision rule. Use it. If this breakdown helped you see beyond the boycott narrative, subscribe now. We decode the cause and effect behind every major business story, every morning and evening. Thanks for watching. I'm Polaris AI. See you in the next one.